All right, this is market update for Texas Investments, January 2023. All the information you're seeing is as of January 2nd, 2023. Looking first at the moving averages, the 50 is back above the 200-day, which is really good. So hopefully we see that continue. As of now, it's really giving us some really bullish vibes. You see that the 50 was below the 200 back in October, kind of crept up in November, above in December, and above again in January. Now, with that being said, as you can see, we only have 5% of the total basket of stocks above their 200-day, but the important thing is that the 50-day is above the 200, meaning that we're doing better now than we were doing a year ago, relatively. All right, so let's look at the sectors first, and then we'll look at some individual companies. The basic sector, as you can see, over the last month, it's really falling quite a bit. That is not the case, however, for Southern Copper, where we are. But let's just look at the sector here. None of these guys above their 200-day, 17%, however, above their 50-day, which is 13% better than the rest of the market. So we're still talking about some fairly low numbers here, right? Only 17% of these companies are above their 50-day, but that's better than 13% of the market. And I think that really says something. Let's take a look at the rest of these guys. None of the communications company above their 200-day. However, 50%, half of these guys are above their 50-day, which is better than, it's 200% better than the rest of the market. And so, this goes back to what I mentioned before about, telecommunications working something like a utility. And so I think that what may be happening is that a lot of investment money is moving into these companies as a way of shoring up their capital, securing their capital, being defensive. And a lot of these companies are also paying a really nice dividend as well, specifically companies like AT&T and so forth. But again, over the last month, as you can see, it looks like everyone really dropped quite a bit. So really curious to see which portfolio came out ahead. I haven't seen this stuff yet. It's my first time. All right, consumer cyclical, doing really well. Really excited about getting back into this sector. 8% above their 200-day, 63% better than the rest of the market. 17% above their 50-day, again, 13% better than the rest of the market. But again, as you can see, really fell out of bed this past month. So yeah, again, really excited to see what's out there for us in this sector. All right, consumer defensive, 5% above 200-day, 9% above 50-day. Really strange. It's really strange, given what gets talked about in the financial news and whatnot, you would think that the consumer defensive sector would be doing way better than the consumer cyclical sector, right? Consumer defensive are typically companies that can raise prices at will. They're companies that, you have to buy their product, right? And they're typically more defensive, meaning that if someone wants to invest their money safely, they were more likely invested in a consumer defensive company and not necessarily a consumer cyclical company, right? Consumer cyclicals are like retail stores, right? When the economy is doing really well, these stores tend to do well. There's been a lot of talk about inflation and stores having to raise prices. And usually, typically, textbook-wise, that does not bode well for a consumer cyclical company. But it seems in this environment that these guys are really doing a lot better than everyone else. I mean, 63% better on the 200-day. That's big. All right. Energy. Energy has been, just a big player over the last, I think, year or if not longer. 16% above their 200-day. But look at this, zero. None of these guys are above their 50-day. And so what that means is that all of these energy companies have really fallen out of the bed. Over the past couple months, we know that the portfolios that have performed or outperformed rather the rest of the market have been portfolios that had these really high flying energy names at the top of the list. So I'm really curious to see if that has changed, being that, now the energy sector seems to be really slowing down. And even though looking at these numbers, they haven't like fallen out of the bed like some of these other guys at 10%. Um, but maybe relatively so if you think about um, being down 10% after having been up 6 and 5, right? Um, maybe that goes to show that energy is really starting to cool off, and so I think maybe moving out of energy and going into consumer cyclicals as of right now seems like the better deal. But we'll take a look at that here in a moment. All right, financials. Again, a sector that I've been really following closely. Really baffled and confused by what's happening right now. Honestly, it's not doing good at all. But it's supposed to, given the economic data that we have, the financials ought to be maybe not soaring, but definitely doing better than this. None of these guys are above their 200-day, only 13% above their 50-day, which is actually worse than the rest of the market. Can you imagine that someone would rather invest in a retail store than invest in a bank right now with inflation and with interest rates? Interest rates means that, it costs more to borrow money to buy retail items. But banks make more money when interest rates go up. So I don't know. It really is a strange thing. Really curious to see kind of what's happening there. The other thing too is, again, I've talked about this before, but inside this financial sector are also insurance companies, and insurance companies tend to make lots more money when interest rates go up. So I don't know. We'll see. The health sector has been a huge surprise, I think, for many people. 29% above their 200-day, which is not like a crazy number, but it's almost 500% better than the rest of the market. However, we're starting to see them cool off because only 14% above their 50-day, which is worse than 3%. So they're actually coming in behind things like retail and telecommunications, I think. So that's really interesting. But yeah, has really been a boom over the last 3 to 6 months for sure. I don't think anyone expected that. All right, industrials. Again, one of those weird situations where it falls in line with consumer defensive. The only difference is that most of these industrial companies provide services and products specifically to big business. There's also some war-making companies in here. I think, let me make sure, or that consumer defense. No. Okay, so yeah, just providing services and products to big industry, and so it makes sense in this environment that these aren't doing so well. But then you look at their 50-day, and 30% of these guys are above their 50-day. So again, just some kind of weird things going on right now with this market, but overall, you can't complain when looking at the performance, right? All right, real estate, 5% above their 200-day, 20% above their 50-day. This is definitely a comeback for sure, because this has not been the better performer over the last couple months at least. And so we're starting to see them really coming back now. I think that's a really good sign. Technology, again, you expect technology not to do so great in this environment, and that is what's happening. None of these guys are above their 200-day, only 11% above their 50-day. And so we cannot expect technology sector to do well until we know that we have a growing economy, and that's just not happening. How and why the retail sector is seeming to do better when technology is what creates all these items in the retail stores just doesn't seem to make a lot of sense to me, but it is what it is. Numbers don't lie. All right, utilities. Utilities have been really good, and it looks like even though, again, just looking at the negative 3% return last month when everyone else was down as well, um, it relative to the rest of the market, utilities have really become some real dogs. I mean, they were doing great, and now just not good at all. So 4% above their 200-day, only 12% above their 50-day. I think what's happening is whenever there's exuberance and excitement and there's a lot of buying, I imagine that a lot of the money is going to go into some of these like growth type of companies, and away from something like a boring utility, right? And then when there's more fear and people are being more defensive, the money tends to flow into something like those utilities. And so I think what's happening here is that by the numbers, right? By the numbers, everything has been really up and down, hasn't really gone anywhere. There's a lot of growth companies that have really been taken out, Tesla, Amazon, Microsoft, those kinds of companies where in the past, when the market is doing really well, those companies are really booming, right? And the stock is really soaring. So we've seen a lot of those guys be taken out. Um, and we did see a move into the utility sector and that sort of thing, those sort of boring names, but are still, like I said, they're safe bets. And so they were really making money. And now we're seeing this thing happening where it seems like money is definitely flowing into more growth, more excitement, I'll say, in the market as far as buying goes. Um, but obviously not as excited and as exuberant as it is in a straight out bull market, right? So it's really strange. It's sort of kind of a real up and down thing. Let's take a look at some of these individuals. So in the utilities, we have WEC as sector leading MVP. The rest of these guys are really spread out. It looks like the numbers have come down some. Looks like the leading performer is SRE at 1.5%. We're currently sitting in EER, which I think is kind of in the middle of the pack when you talk about returns, 0.15 versus some of these 0.7, 0.16 or whatnot. So again, I think, the utility sector is kind of like just pick one. SRE, sector leading performer, but being that it has not been an MVP at all over the last 12 months tells me that this company is probably not investable for us. Maybe the price has gotten so high that the dividend has dropped below 2%, or maybe the price has gone above their $150 threshold. So not sure what's going on there, but ED, maybe the same thing, not entirely sure. But again, I really don't see a reason for us to jump out of ETR right now, being that not only the utility sector seems to be cooling, but I don't see any exciting opportunities to switch to anything else. We'll take a look too at what our portfolio is calling for, just to see if, because I can't remember, but I think maybe that portfolio was calling for ETR, maybe it's calling for something else, not sure. Anyway, moving on to technology, Corning is where we are. That is the sector leading MVP. Happy about where we are there. As you can see, the average monthly return is almost a negative 1%, meaning it's losing money every single month. But compared to the rest of the sector, that's about right. Okay, I mean, you see Intel down here, which has been just a horrible performer over the last year, if not longer. Cisco not doing very well. Hewlett Packard was performing well, and it looks like it just kind of fell out of bed on us. Qualcomm has never really been a great performer. IBM is the thing that's really shocked me. I think I've said that every single month for the last at least 3 or 4 months, where it's not quite the sector leading MVP, but it has done really well as far as price performance. Real estate, fairly large sector. So KIM, talked about that quite a bit, has done really well over the last year, at least. Sector leading MVP. Price performance isn't great, but not horrible relative to the rest of these guys. You see, I think everyone in this sector is negative right now. And so, again, based on the economic data, that's to be expected, right? Interest rates going up means that you're going to have less borrowing to purchase any sort of new home, new construction, new building, or anything like that. I really am happy where we are with MPW. As you can see, the price performance has been horrible. MPW, just to talk about it a little bit, it does these lease buybacks where it purchases the building rather, from the hospital, right? And then rents that hospital back to the hospital. So the hospital is providing the services, okay? So the services don't change. The people inside the hospital don't change. The only thing that changes is MPW gives the hospital cash for the building, and in return, MPW rents that building back to the hospital. So, has the hospital real estate market been oversaturated? Are there a bunch of hospitals sitting around empty and we can't find people to rent to? That's not really the case. Do things get so bad economically that hospitals start going out of business? I don't know. The other thing is that hospitals, for the most part, are very connected to government spending. And so with the government being such a large customer and supplier for these hospitals, it's a fairly safe investment, So again, really excited to get this new quarter numbers, and so I can do this analysis and really see what's going on, because maybe the market knows something I don't. But again, none of these guys really performing very well at all. But I will say again that KIM has done tremendous over the last year. And I think that says a lot about that company compared to the rest of the real estate sector. All right, industrials. And yeah, I was right. So Raytheon is a war-making company. And so that is one of the bright spots in this particular sector, is that we do have a lot of military spending going on right now. And so these companies tend to perform much better in that environment, regardless of what inflation is doing, regardless of what the rest of the economy is doing. If we are at war, governments are spending lots of money, and they're spending it with companies like Raytheon. So sector leading MVP, really kind of splitting time with the rest of these guys. But, way outperforming everyone else. And so, that's one of those things that gets talked about a lot, is, do you invest strictly on, fundamentals, or do you try to, look at, what government may possibly do what? There was a lot of talk for a long time about, this person going to war with this person's going to invade this person. Personally, I don't like investing that way, just because it means that my investment decisions are then based on the whim of some general or some leader, because they can literally just choose not to, right? Or they can choose to. I mean, right now we've had this Ukrainian thing going on with Russia for quite some time. Question is when is it going to stop? Who knows? Right now a lot of money is being spent over there, and that's going to continue, I think, in the short term. But again, when that stops, who knows? How long does it continue? Who knows? Like I said, it's completely at the whim of those in charge of that kind of stuff. But the fundamentals, the money, the profit margins, those types of things don't change much, even when you're talking about wartime, because all that stuff averages out over the course of a number of years, right? Because you have wartime, you have peacetime, and you really want to get a good idea of what the company is doing based on, both wartime and peacetime, right? So anyway, Raytheon outperforming everyone else. We are currently in paychecks, which is again not performing great, but compared to the rest of these guys, especially if I include that one at the very bottom, it's about average. So not horrible. And I do think that Paychex is in a really good position within this sector. So we'll continue to monitor that. All right, healthcare. Really short sector here, primarily because of both dividend and stock price. Pfizer, sector leading MVP, has been the case for quite some time. Cardinal Health, sector leading performer, and that has been the case for quite some time. Merck, however, is where we are, right up there with Cardinal Health as far as price performance, but has not been a sector MVP at all in the last year, which not quite sure why that is. I think it's safe to say at this point that the battle between Merck and Pfizer, Merck has won at least over the last, I'll say, 6 months. Okay, Pfizer, I think, did come out on top with the whole COVID battles going on, but it looks as if Merck has really taken off and done really well again over the last 6 months, if not a bit longer. So happy where we are there. All right, financial services, again, fairly large sector for us. Looks like there is no real sector leading MVP. It's really split amongst all these guys. I think what is important to note, though, is that most of these top MVP candidates are going to be either Canadian banks or insurance companies. So I think that says quite a bit. Sector leading performer, again, is an insurance company at 2%. PFG, I think that's Prudential. I might be wrong about that. No, it's definitely not Prudential. I forget who PFG is. But anyway, that's another insurance company. So 1.5%, MetLife, 1.5%, Allstate, 1.5%. So all of the insurance companies are doing really well. The banks, not so much. And that has been the case for quite some time now. I'm glad we did get out of the high flying Blackstone, which when things are going great, makes a lot of money. And the price performance is mwah, right? But when things aren't going so great, when people aren't investing in the market and pulling their money out of those wealth managed funds, Blackstone is not where you want to be. So glad we're out of there. We are currently in Regions Financial, which I do expect to do better than the other banks. And as you can see there, it's barely positive. But again, compared to what some of these other banks are doing, such as JP Morgan and Citibank, Regions Financial outperforms them. So my expectations are that at some point, the banks will turn, right? And then I think Regions Financial will definitely be in a really good position to take advantage of that turn. But again, looking very much forward to getting the quarter numbers, doing an analysis to really see what this thing is worth. Specifically for banks, book value means everything. And so right now, I don't know what the book value is. If the book value is less than $1, then we know for sure that this is almost for sure a buy, right? If book value is still more than $1, then that may give us a little bit of pause into purchasing more shares. But again, really expecting some really great things from Regions. But yeah, right now, I think insurance is definitely where you want to be. And I think that's going to be the case for quite some time, even though all these guys really lost quite a bit over the last month. Again, if you look at their performance over the last year, 1%, 2% every month has been really good. All right, energy, another, not large sector, but decent size. MPC, still sector leading MVP. As far as performance goes, energy has just outperformed everyone in this market. Even though, as we saw before, that has not been the case over the last 2 months or so. They have really cooled off quite a bit, but even still, looking at the returns, 5% every month, 3%, 2%. You just can't get much. The average is 2.5. You can't get much better than that. So we're currently in ENB, which is not going to outperform anyone in this market at all. But that's the reason why we're in this company, is because it's also not going to fall as hard and as fast as the rest of these guys in the sector. So happy where we are there. Again, if something changes, we'll definitely look at getting out of it. But right now, we're okay where we are. All right, consumer defensive. All right, this one I talked a little bit about, just because, again, you expect this one to do better than the others, and it's just not, for whatever reason. Target, sector leading MVP, sharing those honors with Coca-Cola. But we talked about this before. The price performance for Target has been horrible, and has been the case for quite some time. I haven't followed the company since we held it, I think, more than a year ago now. So really don't know what's going on there. I imagine that, because they were such COVID winners, that at some point someone had to go like, all right, well, COVID is over. So, it's like they can't still be worth as much as they were then, right? Anyway, Coca-Cola looks like it's sort of in the middle of the pack when it comes to price performance. ADM, Campbell Soup, GIS definitely outperforming everyone else in the sector. Campbell Soup, I think, has been a real surprise for me anyway. We were in Campbell Soup. It wasn't doing very well, and it seems like it's come back now. But it has not been an MVP. And so I think maybe that has something to do with dividend. Not certain. But either way, I am happy where we are with Coca-Cola. The price has held up decently. It's paying out a nice dividend. And so we'll continue to monitor the option to sell some calls to exit that position at profit. All right, consumer cyclical. This one is just, I don't know. It's strange. It's strange. Sector leading MVP, IPG. The rest of these guys are really kind of spread out. Starbucks in there, Hasbro in there. The thing that's interesting, though, is how these guys are performing better than the rest of the market. But if you look at their performance, it hasn't been great at all. I think, what is this? OMC? Yeah, OMC is a sector leading performer at 1%. No, sorry, GPC, of course. Sector leading performer at 2%, and then OMC at 1%. Everyone else is negative. So maybe it's GPC that's really carrying this sector. 63% better than the rest of the market on the 200-day, which is like a long-term trend. 13% better than everyone else on the 50-day. So, not blowing anything out of the water really, but just holding up a lot better than what I expected. And I think that has a lot to do with GPC, which we know stock price has just shot through the roof, which is why we weren't able to purchase. Starbucks, I think, is maybe another one, because even though Starbucks is in the consumer cyclical sector, it's almost starting to become something of a defensive play, just because they're so ubiquitous, right? And it's become such a part of American culture that it's almost like you have to have Starbucks. There are some other, of course, boutique coffee shops out there. There's a couple other chains, but when you think about coffee in the States, I think it's think Starbucks is almost synonymous with American coffee. I think it's almost gotten to that point. So I haven't looked at the performance of Starbucks. I'm just looking at this outside gain here, almost 24% in November. So again, GPC I know for sure is carrying the sector, but there may be a couple others that's really doing well as well. Best Buy, so the company that I've followed for quite some time, 31% last month, but overall, negative for the year. So, all right, communication services. Again, Lumen, sector leading MVP. However, the price performance has been horrible. And I think I know we talked about this before, where the reason why Lumen keeps showing up on these best performing portfolios is because it's almost always at the bottom of the list, meaning that there's not a lot of shares of Lumen in that portfolio. I think that clearly there are some companies that have better price performance. Like right now, Rogers is the leading price performer in the sector. This is where we are, but as you can see, it's barely positive. The rest of these guys are negative by quite a bit. So happy where we are with Rogers. I've said this probably for the last 4 years, right? Really hoping that the price drops far enough for us to purchase more shares of Rogers. Every single time it's like the price drops, but we don't have the cash to buy. And then when we do have the cash to buy, the price is not dropped. So I don't know what we're gonna do. We've been holding on to this position now for I think maybe 4 years, maybe a little longer. But again, we'll continue collecting those dividends, and at some point, I do expect the telecommunications sector to turn around because all these guys can't stay negative for long. All right, basic materials. This one I can say, has been a bit of a surprise, but not really. We talked about this before. When you have inflation, basic materials, the prices rise with inflation. That's just the way it is, right? It's a commodity, meaning that it ain't going nowhere. The only thing that can affect it is demand, meaning are we building more things? If we're not building more things, then typically we see a fall off in basic materials. But as long as everything is humming along, employment rate remains low, I think that these basic material guys will continue to make money. Notwithstanding SLVM here, because it's not investable for us, we do own like 10 shares or something. Sector leading performer is CTRA again. I think that has been the case for the last couple of months. FMC second, and then Southern Copper, where we are, comes in third. And when you look at the price performance of the sector last month, you can see most companies really did well. We see some 13s, some 20s. I think there was like 130% increase. And I'll tell you that next month, when we look at the same list, Southern Copper is going to be way up there because, again, we bought it at 52. We contracted to sell it at 60, and the price is currently 73. And doesn't look like it's going to pull back anytime soon. And if it does, I don't know how much it's going to pull back. It's hard to imagine it pulling back all the way 60. So I'm almost certain that we're definitely going to sell out of this position January 20th, and then we'll be looking at either moving into something like a CTRA, maybe APM. We'll see. All right, let's take a look at the results of the portfolios. Looks like alpha up, up down, standard deviation. And at the top here, I do see some betas. That's interesting. And so I'm curious to see if these portfolios are still the ones with MPC as their top holding. I think maybe that's the reason why these are here without MPC in that lineup. I don't know if these portfolios outperform like they have. All right, let's take a look at strictly price performance over the last 12 months. And again, we have up and down again, alpha up, return up, alpha, standard deviation down here. Still top 5. And again, I think these top 4 probably have MPC or some energy name as their top holding, which I'm going to say is a fluke. Even though we know for sure the energy does tend to perform well, especially in inflationary environment, because again, it's something of a commodity. When prices go up, the price of oil is just going to go up. There's just no changing that. Unless, again, you have some really big hit on demand, people are still going to buy gas. That ain't going to change. All right. Let's take a look at some of the worst performers, just to give some contrast here. So dividend portfolios make sense because as the price goes down, the dividend goes up. The fact that there's some beta and alpha thrown in there is interesting. But again, you still see a lot of dividend in here. The other thing that is really interesting here is that there's a lot of M score. And now that I think about it, we go back to the best performing, there's no M score in here. M score is at the very bottom of the list. So that's a change. That's a change because over the last, hard to say, but I remember talking about M score quite a bit because the idea was that portfolio was performing so well because it was a defensive play. You're talking about companies that have a lot of cash on hand. And so they have an ability to go out and buy other companies if necessary. Also, it's just a lot less riskier because so much of the stock price is made up of just cash. So the idea now that the M-score portfolios are becoming the worst performing portfolios means that, I'll say this again, that we really are, I think, starting to see a turn towards more growth, right? Because when a company doesn't have a lot of cash, it means that they're typically using that cash to grow, right? You got to imagine if someone has $1,000 in their pocket, but they're only making $1 compared to the person with $0 in their pocket, but they're making $100, right? One is, we can say, is either spending way too much money or they're using that money to grow the business. And in a lot of situations, that's the case, right? You're making $100, but you're turning around and putting that $100 back into the business versus the company that's making $1 and just holding on to cash, right? Is not necessarily growing very much, but it does appear to be a safer bet, right? As of right now, what we're seeing in the market is that those M-score portfolios are definitely not doing well. People are not putting their money in those safe bets. At the same time, going back to the fact that we are starting to see some beta portfolios as the best performing portfolios, and we talked about that as well. It's where you can definitely make money betting against the market right now, but it's tricky. It's timing, right? It looks like if you did bet against the market over the last year, you will have lost money. Period. Right? You won't have lost as much as some of these other portfolios, but you would have still lost. Okay. At least with our standard deviation, there's a gain there, right? And the difference between these two is just time. Okay. This is 12 months. This is over, I think, like 18 months now, maybe a little longer. Not doing the math right now. But anyway, point is that I still say you cannot necessarily bet against this market. You can make money betting against this market, but it's definitely timing for sure. Let's see this one. Yeah, see, so again, all these betas, and then M score. So it's just not not the way you want to do. And then going back to risk, again, standard deviation is going to almost always be a less risky portfolio. That's kind of the purpose in a standard deviation portfolio. That's where we are. That's the portfolio that we're following. And I think we're going to continue to follow that. However, it looks like if you want, big bang for your buck, right now you do want to go after those beta portfolios, right? But again, it's about timing. Okay, it's about timing, because if you just sit your money in one of these beta portfolios, you're destined to lose. Okay, but on a month by month basis, like I said, if you can time it just right, yeah, you can pull off a 11, 12% return in 1 month. Go back, yeah, in 1 month. The M-score companies, we just talked about that. Those actually are there. There we go. Yeah, the M-score. You see a bunch of M-score in there. So they're not as risky, but interestingly though, they are not making as much as the standard deviation portfolio either. So again, I'm happy where we are with the standard deviation portfolio. I don't see any reason for it to change yet. However, I am kind of keeping my eye on what some of these other portfolios are. So for instance, this is the return up portfolio. And as we can see, contrary to what I thought, energy is not at the top of the list here. Is actually real estate, KIM, which we know has performed really well relative to the rest of the real estate sector. And so that's really interesting. Let's take another look. Just want to make sure I get this right. Yeah, the return up is there. Let's now look at alpha up and alpha down. Or actually, I'll just do alpha up. I don't think we need to do alpha. Alpha up are companies that are going to perform well when the rest of the market is performing well. And again, we see MPC as the top holding. Purchase price of $61, current price at $116. So again, just a really outsized gain. But there's also KIM in there. There's also Corning in there. There's also NEM in there. PARA in there. There's also Target. So a lot of the same companies that we also saw in the return up portfolio are there as well. And that's the reason why, again, this portfolio is really outperforming. If we took MPC out, I'm not so sure this portfolio outperforms everyone else. Matter of fact, it definitely does. I mean, Pfizer is kind of a thing there, but no one else is really doing much of anything. And the utility is at the very bottom. So let's look also too at up and down to see if maybe that's a difference. I was really shocked about the return up portfolio. So again, up and down, we got MPC top holding in the energy sector. AEM, we're seeing them again. Target, seeing them again. Corning again. KIM again. Yeah, Pfizer again. So there is some differences, but largely these portfolios are kind of picking the same, I think, type of company. Now, the interesting thing is this particular portfolio has Target as its third holding, okay? But if you look at the performance, I mean, if you purchase this thing at 240 and now it's 150, you've lost, quite a bit. And so I definitely don't think Target in the consumer defensive sector is where you want to be. But again, that goes back to what type of company this is, right? And that's the reason why we're not necessarily following this particular portfolio, because even though there are some decent performers here, um, I think that solely betting on these type of performances is not really the way you want to go. Let's also take a look at, let's do the beta. Let's do a straight up beta. So remember, these are companies that perform well when the rest of the market is not. Like I said before, I do not suggest betting against this market, but I think it's interesting to see what companies are in that portfolio, to see if maybe we own any of them, or to give us an idea of what we can maybe move into if we were to change anything out. All right, here we go. So Starbucks, talked about them, doing well, and the rest of the market is not. Makes a lot of sense. Number one holding this particular portfolio. Southern Copper is where we are. Makes sense. Coca-Cola, again, makes sense. Paychecks makes sense. So, we're in what, three of these things, right? What's interesting, I think, is that we are looking to replace our consumer cyclical. And Starbucks looks like really nice, a really nice substitution for genuine parts companies. So we're definitely going to take a look at that. Let's see. Right now, standard deviation portfolio is calling for Starbucks. So there you go. Let me see. There we go. So yeah, IPG, OMC, Starbucks at a -8. So kind of in the middle of the sector. OMC outperforming, IPG sector leading MVP. And we've seen IPG and some of these other alpha type portfolios. When the market's doing well, IPG is going to do well. Let's see if it's in this one. Cyclical, OMC, that makes sense. What was the other one? Up, right? Curious now, because I know I saw it. I just don't remember exactly which portfolio it was. But I'm certain it was something like return up or maybe up down. Let's see. Some cyclical. Yeah, IPG. Yeah. So yeah, I think that's also a decent substitution, at least to look and to contrast and compare when deciding where to go in the consumer cyclical sector. All right. One more thing. I'm gonna look at the best performing portfolio. This last month was the up and down portfolio. And looking at this thing, it looks decent. It really does. Other than this bright red spot that I think is going to be similar for all these portfolios, I think this one is doing really well. Looks like the average is a little less than 1% a month, which is about what we're doing anyway. This one doesn't look too bad. Not a lot of green in there, but not a lot of dark red either. Yeah, man. Look at that standard deviation. That looks so pretty. But with that being said, over the last 12 months, by the numbers, this thing's returning -1%. So obviously, again, the eye test, right, says that this looks pretty good. I mean, there's no dark red. There's some nice dark greens in there, and the rest of it is really kind of a lighter shade. You know what I mean? But then you come back over here where you're looking at a portfolio that again does fairly well when the market is doing well, but does have some defensiveness built in because of the down moves factor. Um, it's just darker green. Even though, like I said, it does have that dark red spot, it's just darker green. And so this one is positive for the last 12 months. That's why numbers are important. But it's also why, too, I think it's good to kind of give the eye test because numbers is one thing, but the eye test really, really draws your attention. Really does. That just solely looking at numbers just won't do for you. So again, something like an alpha up, lots of dark green, has that 1 month that isn't very great. Again, average 0.45. And so again, that tells me that if I'm going to replace anything in our portfolio right now, I definitely want to look at adding something that's going to give us some of that alpha that's doing worse than standard score. So yeah, um, yeah, I think that the standard deviation again is a good place to be defensively. It's a safe place to be. But again, if you're looking for more risk, looking to make more money, at this point, I think you definitely want to get into something that's going to perform well when the market is performing well. And if you want to like make any outsized gains, then you can definitely bet against the market. But doing so means that you can't just like put your money in there and leave it there, right? You'd have to really do like some swing trading, not necessarily day trading, but definitely some swing trading to take advantage of those outsized gains in 1 month or another. All right, looking at the 50 and 200 day, um, we can see that there's definitely a downtrend. The 50 day has really been about even over the last year, and it still looks even. If you draw a line across the top and you draw a line across the bottom, I don't think those lines move really up or down. They don't seem to be slanted to me. They seem to be about level, maybe slanted a bit downward. The 200 day is definitely for sure in a downward slope, no question about it. We're definitely not better off today than we were last year. And I think that's going to continue to be the case. At some point, that will change, especially being that the 50 is so up and down, right? And the fact that the 50 is above the 200 day, and it has been for the last 2 months, if we continue to see that, then at some point that 50-day average has to pull that 200-day average up, just because that's the way math works, right? Because 4 50-day moving averages over the next 4 months equals a 200-day, right? So if the 50 continues to climb, then the 200 will climb behind it. And when that 200 gets above that 50, that's very bullish, and it means that the market is really ready to take off. I think that's it. Definitely going to again do some compare and contrast with some of these consumer cyclical companies to see which one we're going to get into. I have gone through some earnings reports. I don't know if I'll post those. And definitely looking forward again to doing the analysis for both regions and medical properties trust.